There are some economic phenomena, financial phenomena, that seem to operate on a much longer frequency than the standard business cycle. Inflation is a good example. But something persistent seems to be at work. Interest rates have much the same pattern. They rise for decades at a time, come down for decades at a time, and so forth. And that suggests, at least, that demographic analysis might be helpful, because one of the slowly evolving features of a population is this age distribution. Well, you can see from this graphical material that we're presenting that, let's say, a generation or two ago, we were very young, lots and lots of children, a very steep population pyramid, as demographers call it, which lays out a population by gender and by age. So you had lots and lots of children. You fast forward to today, and you can see, well, it's not as child-heavy as it used to be. In fact, it's not quite so pyramidal. It's beginning to look a bit like a barrel. But on current patterns of fertility and mortality, if you extend it out for the next 30 or 40 years, you're going to have a much older population than we've ever had before. And that's more or less predictable in the specific sense that you can't manufacture 20-year-olds on the spot. It takes 20 years to get a 20-year-old. It takes 30 years to get a 30-year-old, and so forth. So the bottom portions of that are kind of fixed. Immigration can make some difference, but probably not that much. And the older parts, well, we've had a very good success with the extension of life at old age. So odds are pretty good that that's more or less where we're going. Let's think back to the 1970s, which was a big surprise to the professional economics community, because you seem to have a very adverse shift in the so-called Phillips curve. Phillips curve links unemployment and wage inflation, more broadly inflation. And relative to what had been observed in the 50s and 60s, things just were worse. At any given level of unemployment, you had a lot more inflation. At any given level of inflation, you had a lot more unemployment than you would have expected. The demographic composition, particularly of the workforce, probably contributed to that. Because if you look at the chart, you can see we had a lot of entry-level workers at that time. And there are things we know about entry-level workers. First, they're going to be productive, but they haven't gone up the learning curve yet, so they're not at a high level of productivity. On the other hand, they're in a very steep portion of their age-wage experience. They get their first job, then they get a raise, they get a promotion because their productivity is going up, they're learning on the job. So at any given level of unemployment, you get a lot of wage increases, which helps explain why the 1970s looked the way they did. Stagflation. Stag because the productivity was poor. Inflation, of course, because you were in a steep portion of the age-wage profile of the workforce. The same people who were novice workers in the 1970s have had a career. They've had plenty of time to go up that learning curve. They don't get raises and promotions and so forth at these ages the way they did as entry-level workers back then. So at any given level of unemployment, you're going to see less increase in average hourly earnings. You're going to get a favorable shift in the Phillips curve. We're going to have a lot of old people relative to the rest of society. And I think there are some things that you can anticipate. One of the regrettable features, so far at least, of human experience is that at older ages, there's a certain amount of cognitive decline that has to be anticipated. You're going to need to protect some of these older people against the kinds of mistakes or frauds or abuse, financial abuse, that they might otherwise fall prey to. And frankly, because of the way the 401k system and the IRA system have evolved over the past decades, not everybody's all that well endowed. And we're going to have to find ways to redistribute economic well-being from those who have capital to those who have not, for whatever reason, accumulated their own individual resources. And I think one of the predictable, or at least likely ways of accomplishing that is to have the yields on financial assets go negative after tax and after inflation. I don't want to emphasize that this alone will create the entirety of our future, but it's a background force, and it's a very hard one to avoid. It's a slow-moving, slowly evolving. Again, you can see from the graphic, year by year, the population ages, And against that backdrop, society is going to have to make some adjustment.